Before the world was familiar with smartphones and social media, a different kind of digital frenzy took over Wall Street. It was a time when companies with little more than a .com in their names saw their stock values skyrocket only to tumble in an epic crash. This was the .com bubble, a defining moment in financial history. Today, I'll talk about how the internet boom altered Wall Street in ways that are still felt today. The rise of the internet and the birth of the .com era. The rise of the internet was nothing short of revolutionary, transforming the way people interacted with technology and finance. In 1989, the World Wide Web was introduced, but it was not until 1991 that it became publicly accessible. This new digital frontier opened up unprecedented possibilities. Then, in 1993, the release of the Mosaic web browser made navigating the internet significantly easier, allowing more people to experience and engage with this emerging technology. The rapid adoption of the internet led to an explosive increase in users. By 1995, there were 16 million people online, but this number surged to 361 million by the year 2000. This surge in internet users sparked a wave of new internet companies. Startups that once seemed like mere ideas were suddenly attracting significant attention. For instance, Netscape, which went public in 1995, became a symbol of the internet boom. Its initial public offering was met with overwhelming enthusiasm, with its stock price more than doubling on its first day of trading. Amazon followed in 1997, and its stock also saw impressive gains, reflecting the growing investor interest in online businesses. Similarly, Pets.com, which went public in 1999, experienced a dramatic rise in its stock price, underscoring the intense speculation surrounding internet startups. The media played a crucial role in amplifying the excitement. Stories of tech entrepreneurs making millions overnight and the rapid rise of internet companies dominated the headlines. This media frenzy fueled public fascination and drove massive investments into internet startups. Many investors were swept up in the hype, often investing in companies with little regard for their actual financial performance. The stock market was filled with speculative enthusiasm, as people believed that the internet would usher in a new era of endless wealth. The peak of the .com bubble. The .com bubble reached its zenith in early 2000, a period marked by extraordinary highs and intense excitement. On March 10, 2000, the NASDAQ index, a key indicator of technology stock performance, surged to an all-time high of 5,048.62. This remarkable peak turned the NASDAQ into a symbol of unparalleled success for the technology sector. It was not just a number, but a testament to the feverish optimism that had taken hold of investors and the market alike. During this time, the advertising frenzy was impossible to ignore. At Super Bowl XXXIV in January 2000, .com companies splurged a staggering $2.2 million for just a 30-second commercial slot. This extravagant spending was not merely about promoting products, but about broadcasting an image of endless potential and growth. These companies were more concerned with capturing market attention and expanding rapidly rather than focusing on profitability. Investor sentiment was running high, with many pouring money into tech stocks without considering the underlying business fundamentals. The allure of quick riches overshadowed practical assessments of company health and financial stability. The media played a pivotal role in this speculative madness, constantly hyping up the success stories and projecting unrealistic expectations about the future of these internet ventures. This constant barrage of optimistic news only fueled the frenzy, leading investors to believe that the upward trend would never end. The cracks begin to show. As the euphoria of the .com boom reached its peak, the first signs of trouble began to surface, unsettling the seemingly invincible market. The I2K bug, a fear that computer systems might malfunction when the calendar turned to the year 2000, cast a shadow over the tech industry. Although it turned out to be less catastrophic than anticipated, the lingering concerns led many to reevaluate their investments in technology. Alongside this, experts and analysts started expressing increasing skepticism, warning that the rapid growth of tech companies might not be sustainable. The AOL-Time Warner merger, announced on January 10, 2000, became a symbol of the overvaluation that had taken hold of the market. This high-profile deal, which combined one of the largest internet service providers with a major media conglomerate, was initially celebrated as a game-changing union. However, it soon became clear that the merger faced immediate and long-term problems. These issues not only undermined the perceived value of the companies involved, but also eroded market confidence, casting doubt on other tech ventures. As 2000 progressed, the NASDAQ index, once a beacon of the tech sector's success, began to show signs of decline. The optimistic outlook that had driven the market started to falter and investor confidence wavered. The situation was further exacerbated by a critical article published in Barron's on March 20, 2000, which warned of potential insolvency issues within the tech sector. This piece highlighted the growing instability and sparked concerns among investors, signaling that the once unstoppable rise of the dot-com era might be coming to an abrupt end. The collapse of the dot-com bubble. The excitement that once fueled the dot-com boom turned to dread as the bubble finally burst in March 2000. The Nasdaq, which had soared to an all-time high of 5,040.62, began its sharp descent. This dramatic drop marked the beginning of a long and painful collapse. Several factors contributed to this downfall. The I2K bug, although less severe than feared, had already stirred uncertainty. The Federal Reserve's decision to raise interest rates to combat inflation further squeezed the market. Additionally, a global economic slowdown added pressure, amplifying the fears and leading to a swift and severe decline in technology stocks. Among the high-profile failures, Pets.com and Webvan became symbols of the dot-com era's excesses. Pets.com, known for its sock puppet mascot and aggressive marketing, saw its stock price soar to over $70 per share. Yet within months, it crashed to just 19 cents and filed for bankruptcy. Similarly, Webvan, an online grocery delivery service, expanded rapidly without establishing a solid business foundation. Despite raising substantial funds and reaching a peak valuation of $4.8 billion, Webvan's lack of profitability led to its collapse. Both companies epitomized the pitfalls of the dot-com frenzy: rapid rise, insufficient profits, and eventual failure. The collapse of the dot-com bubble had a sweeping impact on the stock market and the technology sector. The once booming market was now marred by massive layoffs and company closures, creating a wave of economic hardship. Investors who had once poured money into tech stocks without hesitation became wary and more cautious. The long-term effects of this upheaval reshaped Wall Street, influencing investment strategies and leading to a more disciplined approach to evaluating tech companies. The exuberance of the late 1990s gave way to a sobering reality, marking a critical shift in how Wall Street approached the tech sector. Lessons learned and aftermath. The burst of the dot-com bubble left many stunned, revealing the stark reality behind the era's exuberance. The primary lesson from this crash was the danger of overvaluation and the pitfalls of investing in companies with unproven business models. Media hype had inflated expectations to unsustainable levels, making it clear that not every startup could deliver on its grand promises. This period highlighted the critical need for solid business foundations and sustainable growth strategies, lessons that investors and companies have taken to heart in the years since. In the aftermath, a few companies emerged not just intact but even stronger. Amazon, Google, and eBay survived the crash and went on to become giants in the technology sector. Their resilience was a testament to the importance of having a clear, viable business model and adapting to changing market conditions. The challenges of the dot-com era set the stage for a new wave of tech entrepreneurship, where innovation was guided by practical strategies rather than sheer speculation. Looking back, the dot-com bubble serves as a classic example of market cycles. It underscores the cyclical nature of stock markets, where periods of rapid growth can be followed by sharp corrections. This historical perspective helps us understand that while bubbles can cause significant disruption, they also pave the way for future opportunities and innovations. The lessons learned from this era continue to influence how we approach investments and manage business growth today. The collapse of the dot-com bubble revealed the vulnerabilities in a market driven by hype and speculation. While some tech giants emerged stronger, many others faded into obscurity. How do you think the financial world has evolved since then? Drop your comments below, like and share this video if you enjoyed it, and don't forget to subscribe. What historical market event should we investigate next? Your suggestions are always welcome.